Welcome to the Deep Dive. Today, we're taking a closer look, maybe a surprisingly closer look, at a big name in Indian retail, D-Mart.
That's right. A company many see as a model of consistency.
Exactly. So our mission today is really to unpack their latest June quarter performance. We want to figure out how D-Mart is actually doing, and maybe more importantly, ask if it can really keep up these super high valuations everyone talks about.
Especially with the market changing so fast.
Right. So we've gone through a whole lot of detailed financial analysis for this deep dive. And honestly, what we found might make you rethink things a bit about D-Mart. Okay, let's unpack this. So kicking things off with the first bit of analysis. The headline takeaway from D-Mart's Q1FY26 results, it wasn't exactly glowing.
No, not entirely.
Yeah, I mean, revenues were sort of in line with what analysts expected, which okay, sounds fine.
Well, on the surface. Yeah.
But the overall picture, according to our analysis, was actually pretty disappointing. The big red flag right away was this squeeze on margins, a significant one. And the analysis suggests this margin pressure is likely to stick around, which directly caps how much their earnings can grow in the near future.
Which is a problem when your valuation is sky high.
Exactly. The blunt takeaway from this analysis, those rich valuations D-Mart has, they look, well, unsustainable.
And it's really that tension you mentioned between revenue being in line but margins going down. That's key here.
Explain that a bit more.
Well, for a company like D-Mart, known for being super efficient, right? When revenue grows but you keep less profit from each sale, that signals something fundamental is shifting.
So they're selling more but making less on each item.
In essence, yes.
Yeah.
And our analysis points the finger directly at more intense competition, especially these quick commerce guys popping up everywhere.
The instant delivery players.
Exactly. They're forcing D-Mart's hand on pricing, and that hits gross margins. Then you add rising costs for running the stores, wages going up. It puts a direct squeeze on their operational profit.
Right.
And when that core earnings growth starts to slow down because of these pressures, it really undermines the whole basis for those, rich valuations, which were built on the expectation of constant, strong profit growth.
So growth is costing them more now.
That's a good way to put it. Growth at a higher cost.
Okay, that makes sense. So let's get more granular then. Let's look at the actual numbers for the June 2025 quarter, because this is where, well, it gets really interesting. The numbers really tell the story.
They do.
Okay, so based on our analysis, revenue grew 16% year over year in Q1 FY26. Pretty healthy.
16% sounds good.
It does. But importantly, this growth was mostly driven by just adding more stores. Network expansion. Their store count and total retail space both went up by about 14% year over year.
So mostly adding footprint.
Exactly, because the really telling number is revenue per square foot. That only grew by a tiny 2%.
Only 2%. That's marginal.
It really suggests that existing stores aren't necessarily getting much more productive. The growth is coming from building new ones. And digging a bit deeper, we looked at like-for-like growth for the mature stores, the ones open for over 2 years.
Right, the true organic growth indicator.
That was 7.1% in Q1. Also, bill cuts, the number of transactions went up 14% year over year to 9.7 crores. So maybe a slight increase in how much people are spending per visit.
Okay.
Just to put some concrete numbers out there. Standalone stores hit 424 in Q1. That's up 14.3% from 371 last year. Business area also up 14.3% to 17.6 million square feet. And that revenue per square foot figure, rupees 9052.3, up just 1.7% year over year.
Okay, so revenue and expansion look decent, if maybe not stellar on the per square foot basis. But then we get to the margins.
Yeah, the concerning part.
Right. Our analysis flags this as genuinely disappointing margin performance, despite the revenue growth. Let's break it down. Gross margins dropped 30 basis points year over year.
30 basis points. So 0.3% less profit on goods sold.
It's exactly.
Yeah.
Before operating costs. And the analysis blames that mostly on continued competitive intensity. Again, those quick commerce players in FMCG, your groceries, your daily stuff.
Makes sense.
But what's even more worrying is the EBITTA margin. That's earnings before interest, taxes, depreciation, and amortization. Kind of a core measure of operational profitability.
And that dropped more.
Yeah. It fell by 80 basis points year over year, a bigger drop. Our analysis says this is because of a few things hitting at once. One, higher operating costs as D-Mart tries to improve service and build capacity. Two, rising wages, especially at the entry level due to inflation.
Common problem across retail, yeah.
Absolutely. Plus, you've got higher depreciation because they keep building new stores, right? That's a non-cash cost,
Yeah.
but it hits the bottom line. And lower other income also played a part.
So the end result was
Flat net profit, actually down just a tiny bit, minus 0.1% year over year. Same for EPS, earnings per share, also down 0.1%.
Wow, flat profit despite 16% revenue growth.
Exactly. Just to give the consolidated figures for Q1FY26 from the analysis, revenue was rupees 16,359.7 crore, up 16.3%. EBIDTA was rupees 12,199.0 crore, up 6.4%, but that margin was 7.9%, down those 80 basis points. And net profit, rupees 773.0 crore, down 0.1%. EPS at rupees 11.9, also down 0.1%.
So it really throws up that question, doesn't it? Can this model of just expanding physically keep working if the profit from it all keeps shrinking?
That's the million-dollar question, or maybe $1 billion in D-Mart's case. Is the model sustainable like this?
Which leads us right into their strategy. How are they expanding, and what about online? Our analysis calls their physical expansion a healthy cluster-based expansion strategy.
Cluster-based meaning?
So they open 9 new stores randomly. They focus on deepening their presence in areas where they already are, building density. So they opened 9 new stores in Q1, making it 424 total. Over the whole past year, they added 53 stores.
That's quite a lot of new stores.
It is. And they're sticking to their existing 12 states mostly, really building out those clusters. Though, interestingly, the analysis notes their first store in Uttar Pradesh this year. So a slight expansion geographically, too. But the main point is store count and retail area both up that solid 14% year over year.
Okay, so full steam ahead on physical stores.
Yeah.
What about online? D-Mart Ready.
Ah, yes. Here, the analysis uses the term calibrated approach, which sounds like code for slow.
Cautious, maybe?
Very cautious. They're focusing only on large towns where they already have a presence. It's operating in 24 towns, and this is key, they haven't entered any new places in the last year.
No new towns in a year. That is slow for online retail.
Extremely. So why the caution?
What's really fascinating here, and our analysis makes this pretty clear, is that D-Mart Ready is currently losing money as a loss-making venture right now.
Ah, that explains the calibrated approach.
Precisely. So
Yeah.
you have this real contrast. On one side, pedal to the metal on building physical stores. On the other, tapping the brakes hard on the online side because it's not profitable yet.
It shows they're really wrestling with how to compete online, doesn't it? Especially with the costs of delivery and competition.
Absolutely. This dual strategy, fast physical, slow digital, due to losses, it raises big questions about how they'll handle the future. Are they potentially missing out on capturing the online shift by being too cautious, even if it protects profits in the short term?
Yeah, a tricky balancing act. And that brings us back squarely to the big recurring theme, margin pressure. This isn't just a one-quarter thing, is it?
No, not at all. Our analysis points out that Q1FY26 was actually the 4th consecutive quarter that D-Mart's EBIDTA margins dropped.
4 quarters in a row. So definitely a trend, not a blip.
It's an ongoing challenge.
And the analysis lays out the reasons pretty clearly. Number 1, still that intense competition in FMCG. Those quick commerce guys again.
With their instant delivery and sharp pricing.
Yeah, hitting traditional stores like D-Mart hard, especially in cities. And this matters hugely because, according to the analysis, food and non-food FMCG make up a massive 78% of D-Mart's revenues.
So the core of their business is right in the crosshairs.
Exactly. That pressure on gross margins is direct. But it's not just competition, right? There are rising costs, too.
Correct. The analysis mentions increased operating costs. Some of that is investment in better service and capacity for their growing network.
Yeah.
But also rising employee costs, inflation hitting entry-level wages.
That seems unavoidable for most businesses now.
It is a widespread issue, but it adds another layer of pressure onto those margins.
So looking ahead, what does the analysis suggest? Does this pressure ease up?
Unfortunately, no. Based on the analysis, these margin pressures are expected to sustain in the current fiscal year.
Meaning for the rest of this financial year, at least.
That's the projection. And that will directly limit the earnings growth in the near term. If we connect this to the bigger picture, it really highlights the fundamental challenge brick-and-mortar players face now.
The whole retail landscape is shifting under their feet.
It really is.
Yeah.
And for D-Mart, this ongoing pressure raises serious questions about its long-term financial health and whether it can ever get back to its historical profit levels in this new environment. It feels less like a temporary storm and more climate change for retail.
Climate change for retail. I like that. Okay, so if margins are squeezed and earnings growth is limited, this leads us straight to the elephant in the room. Valuation.
Yeah.
What does this all mean for the stock price?
The big question, yeah.
So what our analysis says, quite bluntly, is that D-Mart stock is trading at an expensive valuation.
No surprise to anyone following the stock, perhaps, but the context matters now.
Right. The projected price-to-earnings ratio, the PE for FY27, is still 74 times. 74.
Which is high. Very high.
Especially as the analysis points out, when you consider the moderation in the company's earnings that we've been talking about, high PE usually needs high growth to justify it. So given all that, the recommendation from the analysis we looked at is pretty stark. It considers the stock too expensive and thinks it's likely to generate very less returns in the future.
A strong call.
It is. Let's quickly run through some key projections from the analysis. FY23 actuals to FY27 estimates. Revenues expected to grow steadily from about 43,000 crore rupees in FY23 to nearly 82,000 crore in FY27. So sales keep going up.
Top line looks fine.
EBIDTA also grows in absolute terms from roughly 3,600 crore to nearly 6,000 crore. But, and this is the crucial bit, EBIDTA margins are projected to decline from 8.5% in FY23 down to an estimated 7.3% for both FY26 and FY27.
There's that margin pressure baked into the forecast, shrinking profitability per rupee of sale.
Exactly. Net profit expected to rise from about 2,400 crore to 3,500 crore. EPS projected to go from about 37 rupees to 54.5 rupees.
So profit still grows, just slower and less efficiently.
Right. And that PE ratio we mentioned, it's projected to come down from like 111 in FY23 to that 74.6 in FY27. But the analysis stresses 74.6 is still considered very high for this outlook. Finally, another valuation metric. EV/EBITDA is also projected to fall from 72 down to about 44. The analysis calls this a D rating.
Can you explain that D rating? Why is 74 times PE still seen as very high here?
Sure. So think about it this way. The market usually gives those really high PE ratios, those premium valuations, to companies that are growing earnings fast and expanding their margins, firing on all cylinders.
The perfect growth story.
Exactly. But when earnings growth is slowing down or moderating and margins are actually shrinking, as the analysis suggests for D-Mart, well, that premium valuation gets much harder to defend.
The story isn't as perfect anymore.
Right. So derating just means the market is kind of adjusting its expectations downward. It's valuing each rupee of D-Mart's earnings less highly than before because the future doesn't look quite as bright or as profitable as it once did.
So it's like the market saying, hold on a sec, maybe we got a bit ahead of ourselves with that valuation given these trends.
That's a good way to think about it. The core issue is whether the current share price really reflects this reality of sustained margin pressure and slowing profit growth. Are expectations still too high?
A critical question for investors.
Definitely. So wrapping things up from our deep dive today, D-Mart is still a powerful retailer. It keeps expanding its physical stores, revenue keeps climbing. That's undeniable.
The scale is impressive.
But our analysis shows it's sailing into some serious headwinds. This persistent margin pressure from competition, especially quick commerce, plus rising costs, it's a fundamental challenge.
And it casts a real shadow over whether it can justify that premium valuation.
It does. So the final thought for you listening is this. Despite D-Mart's strong brand and relentless expansion, the analysis points to a tougher road ahead for profitability. How can the company fight back against this quick commerce pressure? What tricks does it have up its sleeve to protect margins while still growing?
Or is this just the new reality? Is lower profitability the new normal for big box retail in this digital age?
Something to definitely mull over. Thanks for joining us on The Deep Dive. And just a reminder, we are not SEBI-registered financial advisors. If you are considering making any investment decisions, please consult a certified financial advisor.